Welcome back everyone to another video by Fully Informed Trade, or Fi Trade for short. My name is Alex and I'm just going to go ahead and review the stock, commodity, bond, and Forex market. So without any further delay, let's go ahead and review these key markets. First of all, dollar index is running into a bit of a double topping pattern right here, top. And as you guys can go ahead and see, double tops are a bit negative. If it can't be broken, it can only go lower, and that would be the $76 level that I've been targeting for quite a while now. As you guys can go ahead and see, the $76 level would look somewhere around here, 76.20, 76.10 is basically your area of support on the dollar index. And remember, that's the last area of support that I can virtually find on the charts, and it's the level that has the highest probability of holding. And if that doesn't hold, the Great Wall of China has broken for the dollar index. Okay, let's go ahead and review the next chart, which is going to be the Euro-US dollar. Euro-US dollar is in somewhat of a sideways pattern at this point, but remember, it is dealing with the double bottom pattern. And a double bottom is pretty much this. It is finding somewhat of support there, but remember, it all relies on foreign events. If foreign events get any more severe in the Middle East, which they probably could, but remember, it has to be something severe, much more severe, something to do with the Suez Canal not being functional or something like that. It had to be something so severe that it would cause jitters and people to sell their stocks, and we're not getting that right now. So for the most part, markets are positive. Now let's go ahead and review this. First of all, Euro-US dollar, chances are it's going to find somewhat of a support if we look at the triangles. It is showing only a midterm trend, so overall it is more of a day trading market than it is a trend following market at this point. So if you're trading the Euro-US dollar, you'd be looking for intraday breakouts or something like that to trade. Something like maybe a channel to trade out of, a flag pattern to look into and stuff like that. That's the type of trades you would more or less try to do inside of this market. And like I'm saying, I am here to review markets, but I'm also here to analyze markets. But more importantly than both those things, I'm also here to teach you guys how to trade different type of markets. Because at some point somebody asked me a very interesting question: how can you tell when you're in a channel or if you're in a breakout? And what I kind of use is trade triangles, and if you're getting somewhat of a mixed signal, that means that you're pretty much in a channel. And another thing that I do want to point out is that when you're trading, channels are somewhat of a flattish type of movement, and they have a tendency to go ahead and move back and forth, but not really go in any general direction. You don't feel any sense of a breakout or a general sense of trend at this point, and you feel that the markets are going a little bit all over the place. And that's exactly what you're going to see with the Euro-US dollar. So because of that, instead of trying to look for trends and trying to play breakouts at this point, you'd be looking for short-term trades intraday, looking for some sort of breakout to play into. And that's pretty much what I would suggest you guys do. Now let's go ahead and look at the next chart, which is going to be the Dow Jones Industrial Average. It does trade much higher, and I'm just going to go ahead and recite some key statistics. Dow Jones Industrial Average went ahead and closed positive by around 0.57%. S&P 500 positive 0.62%. The Nasdaq Composite is positive 0.53%. The New York Stock Exchange Composite positive 0.58%. And the Russell 2000 positive 1.03%. S&P 400 mid cap is positive 0.87%, and the S&P 600 small cap is positive by 1.02%. Alright, so pretty much markets were pretty positive overall. The stronger stocks were obviously the smaller stocks, and the larger stocks did perform moderately well. Another thing that I do want to point out is that the strongest sectors for today were the financials at a 1.46% gain according to the XLF. The next chart or a sector is XLI, which is the industrials that did perform about as good at around 0.94% positive movement. And the next group or sector that I believe performed the best on today's trading was the utilities, XLU, which is a 0.64% gain for the utilities, financials at a 1.46% gain, and the industrials at a 0.94% gain. Overall, markets were pretty positive today, and like I'm saying, we gotta look for some resistance levels, and we gotta be a bit careful. But at this point, what kind of resistance can we anticipate? Now that's a very good question, because markets keep on breaking through resistance levels left and right, and chances are it will most likely continue to do so until something fundamentally changes in the overall global economic picture, something that causes uncertainty, instability. And as far as predicting when everybody wants to get rid of stocks, it's really hard to say when you would have a correction, because the only time you ever have corrections is when everybody has this buy mentality in place. So what I would suggest is to look out for macro events outside of the USA and just keep a very, very close eye on it, because if something really bad happens in foreign countries, chances are that will lead to a really, really bad market in the USA. Um, Also, another thing I do want to point out is this. This market would probably have somewhat of a resistance at around 12,500 to around 12,700. We are getting closer to 2008 highs, or no, yeah, give or take 2008, 2007 highs. So we got to be a little careful here, but remember, every time a market does recover, it generally recovers back to the previous levels within a time frame of around 2 to 5 years. But generally it takes around 3 years or so for them to get back to break even. And you know, it's been around, give or take, yeah, we're nearing our third year. So it'd be no surprise to me if we got around 13,000 to around 13,500 on the Dow Jones Industrial Average by the end of the year. We could have a super strong breakout into the 14,000 area, but that's not something I anticipate until early 2012. Let's go ahead and look at the next chart, which is going to be this SPY. SPY does show somewhat of an inverse hammer. Um, I can't really call that negative yet. We don't really have something. We don't really have a stimulating effect coming out of any economies enough to cause people to sell their stocks. Right now we have extremely low volume, and I do want to point out a key fact that anytime you have really, really low volume in this type of market environment, do anticipate a pretty positive day. And the main reason why you could anticipate a positive market is it's kind of just the way it works. Some people are speculating on Federal Reserve manipulation, and you know there is some truth to that. You do have some Chinese central bank manipulation thrown in there as well. Well, what the Federal Reserve basically does, according to a theory out there, is that you know, the Federal Reserve puts in a buy program, and what happens is that a lot of bonds are pretty much bought, forcing investors in bonds out, and they just more or less buy stocks instead. I know it's just a theory, but pretty much what happens is that people assume that the Federal Reserve has more control in environments with low volume, and the Federal Reserve's main goal is to pump liquidity into the markets, but more importantly push bond investors out of the market and into the stock market, while doing so trying to keep the stock market propped up. Because of that, there might be some validity to those type of thought patterns, but overall the end thesis is that when there is low volume, anticipate a sideways to positive day. If there is a ton of volume, do note that stocks cannot, investors cannot absorb the excessive amount of selling. Thus, therefore, stocks have a tendency to fall on days with higher volume. That's just the way the market environment works. Of course, there might be some case scenarios when earnings are extremely good, so good that volume goes straight through the roof, and you know, but this isn't penny stock investing. This is a global marketplace. This is how real stocks or mega cap stocks can more or less work. Of course, if you're talking about micro cap and small cap stocks, that is a different story. Yes, high volume equals more buying, equals more price. It's a different set of rules. But as far as when we're talking about indexes and stuff like that, you got to keep in mind that low volume equates into higher markets, and high volume generally equates into lower markets. Of course, when you're trading small caps, high volume could either result into a high volume of people selling or a high volume of people buying. Alright, let's go ahead and look at the next chart, which is going to be the gold spot. Gold spot is trading somewhat of a sideways manner. Right now, I really can't recommend a trade in either direction. Unless the dollar index does go lower, gold will more or less trade in the sideways pattern and off into I don't know where. But as far as I'm concerned, it is holding on to the 20-day moving average. It could bounce off that and go higher into the 50-day moving average. It is breaking out of a flag pattern, and that's very positive. Now, from a trader standpoint, at least from my standpoint, it is far safer, I guess, to be a buyer than somebody shorting this market, but at the same time, you don't have a clear risk to reward at this point until the dollar index, until you get a clear confirmation of the dollar index going lower. Let's go ahead and look at the next chart, which is the silver market. Silver's market is breaking out substantially, and like I was pointing out a couple weeks ago, or I think it was last week, that silver did have a flag pattern. It was a very positive indication or a reversal in trend. And that's an interesting point. Silver does go back up. It's trading at around 29.37. It has broken the 50-day moving average, and it also has broken the 20-day moving average as well, which is pretty positive. Back that with a devaluing dollar, and you got a very good risk to reward ratio to the buy side on silver. But remember, keep your stops tight. Don't overly expose your portfolio to excessive amounts of risk. Let's go ahead and review the next chart, which is going to be the bond market. Bonds are very interesting right now. And you know what? It has finally broken out of that 119, give or take 119-ish, 122 area. And I do want to point out, guys, that it was a channel. We didn't get something major enough happen. Stocks didn't quite sell off yet. So overall, bond market is, it did have a good reason to break down. Of course, for all those people who are trading, I did point out that you did have a good risk to reward ratio, and every time I more or less got into around the 119 area, it did work out for me from a trading standpoint. Of course, the fifth time was the time that it didn't really work out. But remember, if you can spot out a channel when two out of three times, maybe 3 out of 4 times, keep your stops tight, keep your trades more profitable than they do result in losses, then of course you could take the losses here and there. But remember, there's no such thing as a trading system that results in 100% success ratio. So always keep that in mind when you're trading. Okay, the next chart is going to be the crude oil market. Crude oil market, I was anticipating an inverse head and shoulder, but right now this chart is going a bit further back than what I was anticipating, but it might be bouncing back a bit, might be bouncing back as well. Now, a key point that I do want to bring out was that I felt that crude oil was a bit overbought, and it was event driven, so I wasn't that comfortable, and I really thought that the market could pull back a bit, which it most likely did. We got the pullback that would have been signalized by the beginning pattern of an inverse head and shoulder, but the shoulder don't match up. That shoulder doesn't really match up this shoulder, so it's really kind of hard to say. It's up for grabs right now. We just got to watch the dollar index and the crude oil correlation very closely. I'm going to go ahead and see you guys in part 2 of my video, so please go ahead and go to it.